Is now the right time to buy stocks? 2025 Market Outlook. Is now the right time to buy stocks in 2025? With markets facing inflation concerns, shifting interest rates, and rapid growth in sectors like technology and clean energy, many investors are wondering whether to jump in or stay cautious. In this video, we'll break down the current market outlook, key trends shaping 2025, and what you should consider before making your next move. By the end, you'll know how to approach today's market with confidence. So before we start, make sure to hit the like button and subscribe to my channel. 1. The big question: timing the market in 2025. Every investor, whether beginner or seasoned, faces one timeless question: when is the right time to buy stocks? In 2025, this question is louder than ever as global markets sit at a crossroads. On one hand, optimism is fueled by technological breakthroughs, steady corporate earnings, and the rapid rise of artificial intelligence reshaping industries. On the other hand, uncertainty lingers due to inflationary pressures, changing monetary policies, and geopolitical tensions that could shift investor sentiment overnight. Timing the stock market is notoriously difficult, even for professionals, because short-term moves are often unpredictable. However, instead of trying to perfectly time the market, the smarter approach is to understand broader market conditions, economic cycles, and sector-specific trends. Investors in 2025 need to balance caution with opportunity. This means carefully evaluating whether stock prices today represent fair value or inflated speculation. More importantly, it requires assessing your own financial goals, risk tolerance, and time horizon. For long-term investors, even if markets are volatile in the short run, buying quality stocks at reasonable valuations can still lead to strong growth over years. So rather than asking if it's the perfect time, the real question is, how can you position yourself wisely in 2025's evolving market landscape? 2. Global economic landscape in 2025. Before deciding whether it's the right time to buy stocks, you need to look at the global economic backdrop of 2025. The world economy is experiencing moderate growth, with developed markets stabilizing after years of inflationary challenges. The US economy is showing resilience, supported by strong job markets and steady consumer spending. But the Federal Reserve's interest rate policies remain crucial in shaping investor behavior. Europe, while facing slower growth, is seeing renewed interest in clean energy and automation, which are fueling corporate investment. In Asia, powerhouse economies like China and India are pushing forward, with China focusing on stabilizing real estate and technology, while India benefits from demographic growth and digital expansion. Another factor shaping the global outlook is supply chain resilience, as companies diversify away from reliance on a single country. Additionally, currency fluctuations, energy prices, and global trade policies play into the broader investment climate. For investors, this means opportunities exist, but so do risks. A stable economy generally favors stock growth, but sudden shocks, like unexpected policy shifts, commodity price spikes, or geopolitical conflicts, can disrupt markets. Thus, the global economic landscape of 2025 can best be described as cautiously optimistic, offering growth potential while demanding vigilance. 3. Interest rates and inflation. The key drivers. Interest rates and inflation remain the heartbeat of financial markets in 2025. Over the past few years, central banks have struggled to strike the right balance between controlling inflation and sustaining economic growth. While inflation has cooled compared to the peaks of 2022 to 2023, it still sits slightly above central bank targets in many regions. This means rates are not as low as the cheap money era of the 2010s, but not as restrictive as during the tightening cycles of 2022. For stock investors, interest rates directly impact valuations. Higher rates make borrowing more expensive for businesses, slowing expansion, while also making bonds and savings accounts more attractive compared to riskier equities. Conversely, when rates stabilize or decline, growth stocks, especially in technology, tend to surge as future earnings become more valuable. Inflation, meanwhile, eats away at consumer purchasing power and corporate profit margins if costs rise faster than revenues. The sectors most sensitive to these dynamics include real estate, utilities, and consumer staples, while energy and commodity stocks may benefit from inflationary environments. Understanding the interest rate cycle in 2025 is essential. If rates trend downward, markets could rally significantly. If they stay elevated or rise again, expect more volatility. 4. Stock market performance. So far in 2025. Looking at market performance so far in 2025 provides key insights into whether it's a good entry point for new investors. The US stock market, led by the Standard & Poor's 500, has seen mixed performance. Strong growth in technology and healthcare balanced by lagging performance in cyclical sectors like real estate and retail. The Nasdaq continues to benefit from AI-driven companies, semiconductor expansion, and cloud adoption, while energy stocks have held ground due to resilient oil prices. Meanwhile, small-cap stocks remain more volatile, as higher borrowing costs impact their profitability. Internationally, European indices are steady, while Asian markets are mixed, with India outperforming due to structural reforms and China struggling with growth concerns. These trends highlight the importance of diversification. If you invested only in one sector, returns might look unstable. However, a diversified portfolio spread across industries and regions has provided more consistent growth. Another factor investors are watching is corporate earnings. Many companies are beating expectations, but forward guidance is cautious due to economic uncertainty. 5. Sectors poised for growth in 2025. When deciding if now is the right time to buy stocks, investors should look beyond the overall market and focus on sectors driving future growth. In 2025, technology remains a dominant force, with artificial intelligence, semiconductors, cybersecurity, and cloud computing leading the way. Healthcare is another strong contender, especially with aging populations worldwide, and new innovations in biotech and personalized medicine. Renewable energy and clean technologies continue to attract capital as governments push aggressive climate goals and corporations transition towards sustainability. Financial technology, fintech, is gaining traction as digital payments, blockchain applications, and decentralized finance mature. On the consumer side, e-commerce, luxury brands, and digital entertainment are strong areas of growth, particularly in emerging markets. On the defensive side, utilities and consumer staples provide stability in uncertain times, offering steady dividends. Meanwhile, energy companies remain relevant, balancing oil demand with clean energy investments. Investors in 2025 should consider sector rotation strategies, shifting focus between growth and defensive industries depending on economic cycles. 6. Risks and uncertainties to watch. No investment outlook is complete without examining the risks that could derail the stock market in 2025. The first major risk remains inflation and monetary policy missteps. If central banks raise rates too aggressively, economic slowdowns could follow. Second, geopolitical tensions, from conflicts to trade wars, can shake investor confidence and create volatility across global markets. Third, corporate debt levels remain elevated, particularly in small and mid-sized businesses, raising concerns if borrowing costs stay high. Fourth, technological disruption, while exciting, also brings risks. Cyber attacks, regulatory crackdowns, or bubbles forming in overhyped sectors. Additionally, climate change and extreme weather events present both financial and operational risks for industries. Investors must also be aware of behavioral risks. Panic selling, chasing trends, or over-leveraging portfolios can magnify losses. The best way to manage these uncertainties is through diversification, disciplined investing, and maintaining a long-term perspective. Now, if you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.